5,002 tons. That is the number that just changed history. Thursday, January 29th, 2026. U.S. Eastern Time. Morning session. The World Gold Council, the official keeper of global gold demand data, just confirmed what we've been watching unfold in real time. 5,002 tons of gold demand. For the first time in recorded history, global gold demand has broken through the 5,000-ton threshold. The dollar value? $555 billion. Let that sink in. That's not market cap. That's actual demand. Physical metal, ETFs, bars, coins, central banks, all of it. $555 billion of capital that said, we are terrified. Get me out of paper assets. And here's the kicker. $89 billion of that came from ETF inflows alone. Record-breaking. The largest institutional rush into gold in modern history. But why today? Why is this happening right now, on January 29th, 2026? Because the AI bubble just started its collapse sequence. Microsoft, down 6.5% in after-hours trading. Azure growth disappointed. The $280 billion OpenAI gamble is now being questioned by every analyst on Wall Street. Nvidia, the poster child of the AI revolution. Stuck. Frozen. Down 38% from its all-time highs. New export restrictions just got imposed. The momentum is broken. Intel, 17% plunge on January 25th. AI chip demand, the thing they told you was unstoppable, is crumbling. And what's the pattern? Every single time a tech stock bleeds, gold hits a new all-time high. Gold is currently trading at $5,538 and $69 per ounce. It touched $5,591 intraday. All-time highs. Historic territory. Capital is fleeing Silicon Valley. The smart money saw this coming. Goldman Sachs CEO warned of a 10 to 20% correction. MIT released a study showing 95% of businesses deploying AI got zero value. Deutsche Bank called the AI boom unsustainable. The dominoes are falling, and the herd is doing exactly what they always do. Chasing safety after the crisis has already begun. Louise Street from the World Gold Council said it explicitly. She cited the AI-driven equity bubble and excessive stock market valuations as the primary drivers of this historic gold demand surge. Translation: investors are panicking. They're dumping their Magnificent Seven portfolios. They're exiting cloud computing dreams. They're liquidating their AI exposure. And they're running, sprinting, into the supposed safe haven of gold. But here's what they don't understand. Here's what Wall Street won't tell them. If you are buying gold today at $5,538 per ounce, after an $89 billion institutional stampede, you are not being smart. You are joining the herd. You are buying insurance when the house is already on fire. You're paying peak premiums for peak fear. You're getting in after the move has already happened. Because the smart money, they're not buying gold anymore. They stopped buying gold weeks ago. The smart money is buying the metal that lags. The metal that Wall Street ignores. The metal that's mathematically coiled to snap upward like a slingshot. They are buying the metal that industrial survival depends on. The metal that Samsung just locked up with a $7 million prepaid deal. The metal that China just classified as a strategic material and slapped export controls on. They are buying silver. And if you don't understand what I'm about to show you, you're going to miss the asymmetric trade of the decade. Stop. Before we go any further, I need to know who's watching this video right now. Because there are two types of people in this audience. Two tribes. And you need to pick a side. Tribe number one, the defense players. These are the people who want to preserve wealth. They want safety. They want to sleep at night knowing their net worth won't evaporate. They buy gold because CNBC told them it's a safe haven. They're playing not to lose. Tribe number two, the offense players. These are the people who understand that preservation isn't enough. They want asymmetric upside. They want the trade that doubles or triples while everyone else is congratulating themselves for staying flat. They're playing to win. Which tribe are you in? Here's how I'm going to find out. If you refuse to hold worthless paper dollars while the AI bubble bursts, if you understand that the only real money is what you can hold in your hand, hit the like button right now. That's your signal. That's your vote that you're exiting the fiat system, that you understand the game is rigged, that you're not going to be the sucker holding depreciating currency while Wall Street insiders position themselves in hard assets. Hit that like button. Let the algorithm know we're awake. But here's the real test. I want to take a vote right here, right now. Look at your portfolio. Look at your net worth. Imagine you had to make one bet. You had to put your entire life savings, everything you've worked for, into a single asset for the next 12 months. No diversification, no hedging, just one metal. Would you pick the safe shield of gold? Or would you pick the rocket ship of silver? Go to the comments right now and type either Team Gold or Team Silver. I want to see which army is bigger. I want to know who's playing defense and who's playing offense. I want to know who's chasing the herd and who's positioning with the smart money. Vote now. Type it. Team Gold or Team Silver. Because what I'm about to show you is going to make this decision crystal clear. Let's talk about the trade Wall Street doesn't want you to see. Silver is currently trading at $117.30 per ounce. It touched $119.34 intraday. Now watch this. Gold, 5,538.69. Silver, 117.30. Divide gold by silver. The gold to silver ratio is currently 47 and 21 to 1. Let me say that again. 47 and 21 to 1. That is the lowest ratio in 14 years. Do you understand what that means? Let me spell it out. The historical norm for this ratio, going back decades, is 55 to 1 up to 80 to 1. That means gold is usually 55 to 80 times more expensive than silver. In 2020, during the COVID panic, this ratio spiked to 125 to 1. Gold was 125 times more expensive than silver. But right now it's 47 to 1. Silver has been compressing, catching up, closing the gap, and it's just getting started. Look at the last 7 days of performance. January 22nd to January 29th, 2026. Gold, up 15.8%. Went from $4,782 to $5,539. Silver, up 28.8%. Went from $91.11 to $117.30. Silver is already outperforming gold by nearly 2 to 1, and we're only in the first phase of the catch-up. But here's where it gets interesting. This pattern, this lag and snap pattern, has happened before. And when it happens, silver doesn't just beat gold. It destroys gold. Let me give you 2 historical examples. 2 forensic case studies that prove this isn't speculation. This is pattern recognition. Example number 1, 2008 to 2011. The financial crisis hits. Everyone panics. Capital floods into gold. Gold rallies 168%. Hits $1,920 per ounce. Incredible run. But silver? Silver rallied 391% to $48.24. Silver outperformed gold by 2.3 times. Example number 2, 2020 to 2021, COVID lockdowns. The world shuts down. The ratio peaks at 125 to 1 during the panic. Gold is the safe haven again. But over the next 18 months, silver rallies 104%. Why does this happen? Why does silver lag and then explode? Because gold is money. But silver is both money and a strategic industrial commodity. Gold investors are motivated by fear. When fear peaks, they buy. When fear subsides, they sell. But silver investors? They're motivated by fear and scarcity. Because silver isn't just sitting in vaults. It's being consumed, destroyed, used up in manufacturing processes that cannot substitute it. When the ratio compresses, it's telling you something. It's telling you that industrial demand is catching up to investment demand. It's telling you that physical scarcity is starting to override financial fear. And right now, at 47 to 1, the ratio is screaming. Let me show you what the math says. If the ratio compresses to 40 to 1, which is conservative based on historical precedent, and gold stays at $5,500, silver goes to $137.50. That's a 17% gain from current levels. If the ratio compresses to 35 to 1, which is moderate based on the 2011 playbook, and gold rallies to $6,000, silver goes to $171. That's a 46% gain. If the ratio compresses to 31 to 1, like it did in 2011, and gold hits $6,500, silver goes to $210. That's a 79% gain. Gold investors are celebrating 15% gains. Silver investors are positioning for 50 to 80% gains. That's the difference between playing defense and playing offense. That's the difference between joining the herd and following the smart money. But here's what makes silver different. Here's why this isn't just another precious metals trade. Gold is money. It sits in vaults. It gets bought. It gets sold. It's financial. Silver is strategic weaponry. Let me prove it to you. October 2025. Samsung Electronics, one of the largest technology manufacturers on the planet, signs a deal with a silver mining company. La Parilla Mine in Mexico. The deal, $7 million. Prepaid. Cash. Upfront. In exchange, Samsung gets 100% exclusive rights to the mine's entire silver output for the next 2 years. Why would Samsung do this? Why would a tech giant bypass the spot market, bypass the ETFs, and lock up physical mine supply with a prepaid contract? Because Samsung is about to mass-produce solid-state batteries, the next generation of battery technology. And solid-state batteries require silver. Not a little bit of silver. Significant amounts of silver. And there is no substitute. You cannot make a solid-state battery without silver. Period. Samsung looked at the global supply chain and realized something. They realized that if they wait to buy silver on the open market when they start mass production, the price will skyrocket. Supply will evaporate. So they did what smart money always does. They locked it up before the squeeze. And they're not alone. China, on January 1st, 2026, officially classified silver as a strategic material. They implemented export controls. China produces 60 to 70% of global refined silver supply. Let that sink in. The world's largest silver producer just said, "We're keeping this for ourselves." Now let's talk about the Pentagon. The United States Department of Defense uses silver in missile guidance systems, radar technology, submarine electronics, nuclear control rods. You cannot substitute silver in these applications. The conductivity properties are irreplaceable. And the US is expanding its nuclear energy build-out by 4 times by 2050. Small modular reactors, SMRs. Every single one requires silver for control rod mechanisms. The Pentagon isn't buying silver because it's a safe haven. They're buying it because industrial survival depends on it. Now let's look at the physical market. The actual metal, not the paper contracts. The real stuff. COMEX, the futures exchange where silver trades, just lost 26% of its registered inventory in 1 week. 33.45 million ounces withdrawn. Lease rates, the cost to borrow physical silver, exploded to 8%. The normal rate is 0.3 to 0.5%. That's 16 to 26 times normal. In Shanghai, physical silver is trading at an 11% premium over the COMEX spot price. What does that tell you? It tells you that people with actual money are willing to pay more than the paper price to secure physical delivery. The paper market is a lie. The physical market is the truth. And the physical market is screaming shortage. This is the industrial floor. This is why silver can't collapse like gold can. If gold drops 20%, jewelry demand picks up and the market stabilizes. Gold is optional. It's psychological. But if silver drops 20%, Samsung sweeps in and locks up every available ounce. The Pentagon steps in and secures strategic supply. Industrial buyers don't care about sentiment. They care about supply chains. Silver has a floor that gold doesn't have. And that floor is rising. Because here's the thing nobody's talking about. The 5,002 tons of gold demand. That's financial fear. People running from the AI bubble into a perceived safe haven. But the silver demand? That's industrial survival. That's China saying, "We're keeping ours." That's Samsung saying, "We're locking up mines." That's the Pentagon saying, "This is a strategic material." You cannot print silver. You cannot substitute silver. And you cannot manufacture it in a lab. The herd is buying gold at all-time highs because they're scared. The smart money is buying silver at a 14-year low ratio because they're calculating. Let's bring this all together. The AI bubble is popping. Microsoft down. Nvidia stuck. Intel collapsing. Goldman warning. MIT proving it's worthless. Deutsche Bank calling it unsustainable. And what's the herd doing? They're panic buying gold. $89 billion in ETF inflows. 5,002 tons of global demand. $555 billion of capital fleeing into this safe haven. They're buying at $5,538 per ounce. All-time highs. Peak fear pricing. And they think they're being smart. They think they're protecting themselves, but they're not. They're buying the asset that's already moved. They're paying maximum price for maximum certainty. That's not investing. That's emotional decision-making. Now let's talk about what the smart money is doing. They're looking at the 47.21 to 1 ratio, the lowest in 14 years. They're looking at the 7-day performance data. Silver up 28.8%, gold up 15.8%, silver already outperforming. They're looking at the historical precedent, 2008 to 2011. Silver outperformed gold by 2.3 times. 2020 to 2021. Silver rallied 104% during ratio compression. They're looking at Samsung locking up mine supply with $7 million prepaid deals. They're looking at China's export controls on 60 to 70% of global refined supply. They're looking at COMEX losing 26% of registered inventory in 1 week. They're looking at lease rates at 8%, 16 to 26 times normal. They're looking at Shanghai paying an 11% premium over COMEX spot. And they're seeing what the herd doesn't see. This isn't a safe haven trade. This is a supply squeeze disguised as a precious metals rally. The math is simple. Conservative scenario asterisk ratio compresses to 40 to 1. Gold stays at 5,500. Silver hits 137.50. 17% gain. Moderate scenario asterisk ratio compresses to 35 to 1. Gold rallies to 6,000. Silver hits 171. 46% gain. Aggressive scenario asterisk ratio compresses to 31 to 1 like 2011. Gold hits 6,500. Silver hits 210. 79% gain. Now let me ask you something. Would you rather make 15% with the herd in gold? Or would you rather position for 50 to 80% gains with the smart money in silver? Would you rather buy the asset that just had $89 billion of institutional inflows and is sitting at all-time highs? Or would you rather buy the asset that's at a 14-year low ratio with industrial demand creating a physical floor? This isn't financial advice. I'm not telling you what to do with your money, but I am telling you what the data says. I am telling you what the forensic evidence shows. The herd bought gold at $5,538 because Louis Street told them the AI bubble is scary. The smart money is buying silver at $117 because the 47 to 1 ratio won't last. The herd is motivated by fear. The smart money is motivated by math. And history shows us, over and over again, that when the ratio compresses, silver doesn't just keep pace with gold. It obliterates it. So let me ask you one more time. Did you vote Team Gold or Team Silver in the comments? Because if you voted Team Silver, you need to understand something. This is just the beginning. The 7-day performance showing silver up 28.8%, that's the warm-up. The Samsung deal, that's the canary in the coal mine. The COMEX inventory drain, that's the warning shot. The China export controls, that's the supply shock. The 47.21 ratio, that's the mathematical coil. And when it snaps, when the ratio breaks below 40 to 1, below 35 to 1, down to 31 to 1 like it did in 2011, the move is going to be violent. Because here's what happens. The herd that's buying gold today is going to look at their 15% gains in 6 months and feel smart. But then they're going to watch silver rally 50, 60, 79%. And they're going to feel sick. They're going to realize they bought insurance at peak premiums instead of buying the asymmetric trade. They're going to realize they played defense when they should have played offense. And by the time they pivot, by the time CNBC starts talking about silver, by the time the herd floods into silver ETFs, the smart money will already be out, already taking profits, already repositioned. Because that's how it works. The smart money doesn't buy what's popular. They buy what's mathematically undervalued. They don't buy at all-time highs. They buy when the ratio is at 14-year lows. They don't follow Louis Street's fear narratives. They follow Samsung's supply deals. And right now, right here, on Thursday, January 29th, 2026, the asymmetric trade is silver. Not because I say so, because the data says so. 5,002 tons of gold demand. That's the herd. 26% COMEX inventory drain. That's the smart money. $89 billion in gold ETFs. That's fear. $7 million Samsung prepaid mine deal. That's calculation. So here's my final question for you. Are you going to join the 5,002 tons herd buying gold at all-time highs? Or are you going to position with the smart money buying silver at a 47.21 ratio? Are you going to buy the safe haven after it's already moved 15.8% in 7 days? Or are you going to buy the industrial squeeze that's already up 28.8% and is mathematically coiled for 50 to 80% more? Don't be the person who bought gold because CNBC told you to. Be the person who bought silver because the math told you to. If you voted Team Silver earlier, get ready. The 47-to-1 ratio is about to break. And when it does, you're going to watch the wealth transfer happen in real time. Subscribe to this channel because I'm going to be documenting every single move, every percentage point of ratio compression, every million ounces drained from COMEX, every Samsung deal, every Pentagon procurement, every China export restriction. This is the crime scene. And the crime is happening right now. The herd is buying the wrong metal. And you just got the forensic evidence to prove it.